Righto, Muddy Waters. We're bloody delivering some yellowcake love for the punters out there. All lithium last year, possibly all uranium this year, mate. And tell you, this poor bastard, Jesus Christ, he's been on some podcasts, but he must love it. There's obviously an incentive in it. Justin Huhn, Uranium Insider, joined Money of Mine. It was, mate, it was similar to interviewing old Joe for lithium. This guy's he's obviously balls deep in uranium, covers it all and all over it. Nah, she was a bloody good yarn. What did you think, boys?
Well, I mean, we covered a shitload of ground. The one concern I had, being completely upfront with you blokes, is that there's a lot of this sort of focus on price. Whenever, it's the same with lithium, but now it's all the go with uranium, and everyone's like, oh, what number is it going to go to, and all of that. But it's actually pretty cool to peel back the curtain and learn a bit about, Kazatomprom, about what he thinks at Cameco and all these various other operations around the world, and get a bit more of a feel from someone who's, been in and out of the uranium space for a good little while now.
Yeah, and I think it was, we did pose the question. It's like, because we don't want to be the pump. It's like, right, what catalysts around the world could possibly fail this uranium thesis that's going on? Because it's, as you said, Trav, if something's got that much hype, that is one problem usually.
It is usually a red flag, yeah. And I think, most of the discussion was oriented around the supply and demand dynamics of the market. I think we learned a fair bit unpacking some of that. It was pretty interesting to kind of go through the geopolitical dynamics and where all that lands. But yeah, I mean, I think the punters who listen, who have exposure, hopefully they'll get something out of it, and hopefully we present it in a way where we try and be balanced in an outlook rather than in the hype cycle.
I think we did it well. Right. Now, if you're into uranium, no better place to bloody park up for an hour and a bit and listen to this. Mate, and another thing about uranium, I thought it would be quite appropriate to talk about two possible companies that might get involved in uranium in Australia. And they've already taken the first step with yellow on their logo. That is a leading indicator, I see, because SMEC are back in the house. SMEC Power and Technology, the electrical gurus for the mining industry. Marty Law and the team, welcome back to Money of Mine. Oh, bloody excited to have them back.
Me too, Matty.
Love it. Mate, I wouldn't even say they're like the Bunnings for the electrical industry. I'd say they're the Myer of the electrical industry. They're not the bloody Bunning, not all the cheap shit. Premium. Absolute premium, not plucked anywhere from China. Like you think of Trav, you love your tools and everything. You go buy a spanner, you go get those cheap as fuck super tool spanners. Yes. Bloody, you'd snap them with a bit of bloody too much pressure on it.
I don't feel like.
Or go to Total Tools and get Sid Chrome.
Yeah, that's what you want to do.
SMEC are the Sid Chrome. They are the bloody premium electrical spanner of the industry. Yeah, bloody mate. I'm telling you. These blue boxes, the electrical boxes, fabricated by SMEC themselves, mate, they're just lined up at the factory, ready to go out the door. Mate, bloody jumbo boxes, substations, fan starters, mate, just flying out the door. Ready to go, boys. Mate, talking about those fan starters, remember the VSDs from last time? Here's a bit of bloody, make sure you're keeping up to date on your underground mining, boys. Remember the VSDs?
Mate, how could I forget?
Variable speed drives for your secondary vent systems. Mate, because until we've got nuclear power powering our bloody mine operations, mate, we're just burning through diesel quicker than bloody Usain Bolt runs the 100.
You've got to be prudent. You got to manage those costs.
Exactly. Now, these VSDs solve that problem. Over half the diesel used can be saved by using a SMEC VSD, because you can run a 220 kilowatt fan on 3 kilowatts, 3 only, boys, and keep the bag inflated, which means you're running it on absolutely bugger all, but enough air to keep the bag inflated. Trucks don't rip the vent down. Mate, you're saving on vent. You're saving on power. You don't have to flick the vent bag. The vent bag doesn't flick off its head when you start the fan up, mate. It's just a no-brainer. Get a VSD on your site, because while we're waiting for bloody uranium power to be approved, we're going to be chewing diesel and you want to save that, and SMEC can do it for you. It's bloody as simple. Isn't it as simple as that, JD?
Mate, it sounds like free money.
It's
Give
a
me the
free
phone number.
bonus. As Edward Rigg would say, give yourself a free bonus. Mate, and because another proud yellow logo in the Money of Mine repertoire, KCA. Now, we know Adam Wilson has never said no to anything in history. And like the only time I think he has said no is when someone asked him, is there any piece of machinery you will never buy or hire out? And he said, no, there is nothing I would not buy. No, that is the only time. Now, because we've talked about KCA's capabilities in hiring out machines and people for underground and surface mining, but I think I have some insight into where KCA might be heading into this nuclear renaissance.
Enrichment? No, what are they doing?
Well, I think that KCA are strongly considering hiring out small modular reactors to the mining industry to power mine sites. Because, boys, you think of all the synergies. So KCA hire out the reactors because they'll just buy them. SMEC can run all the electrical integration and installation for the reactors on the mine site. And Australian mining will be the greenest it has ever been, probably because of KCA. Actually, and because I got some word on the decline that Adam Wilson is possibly running for the Liberal seat of South Perth.
Is he really?
Yeah. Don't worry about Basil Zemplers, boys. Forget about him. Adam Wilson and KCA are probably taking control of the Liberal Party and bringing nuclear energy to WA mining.
Someone's going to call Adam and be like, hey, mate, I heard you're getting into the SMR business.
Mate, if there is one man I would vote for and the people would vote for, it's Adam Wilson. Let's make it happen, West Australia.
Was this a political ad or a...
Vote one, Adam Wilson.
This ad has seriously derailed. I mean, KCA do not sell or hire out SMRs. And now it's a
But they
political...
could. If there's one company that could do it, I reckon it's KCA.
Adam's going to give some feedback that he hates this ad worse than the one where I accidentally called him something that I didn't have.
Oh, thanks to bloody KCA and SMEC, just powering the mining future for Australia. So on that note, showing that there is companies willing to take nuclear to the next level in Australia, let's get into our chat with Justin Huhn from the Uranium Insider. Here we go.
Vote one.
Righto, buddy miners, let's get into it, mate. We've gone from bloody Mr. Lithium last year. Now we are going to Mr. Uranium. How times have changed so quickly. Now, this guy's last name, Trav, it's spelt Huhn, Huhn, but I think it's more pronounced Hoon because there's going to be a shitload of you in this bloody chat, mate. Justin, welcome to Money of Mine, Cobber. Justin Huhn.
Yeah, that's actually probably the closer to the correct pronunciation, right? It's German, and it's pronounced Huhn. It basically means hen or chicken in German.
Oh, you and JD
that.
can talk about bloody sausages and stuff today. He's German as well.
We'll save that for after the podcast.
JD loves smack talk. Hey, welcome to the bloody. You've probably done some Aussie podcasts before, but you're the go-to man in this new pending yellowcake mania, mate.
Yeah, I suppose. It's something we've been focusing on 100% for the last almost 5 years. So we've built up quite the network of connections in the industry and have a wide-reaching newsletter, and I've built up a small team behind me, and it's been quite the run. And we think we have a ways to go here. We're very constructive on the space right now, but yeah, there's always a lot going on in the uranium space, so there's always a lot to talk about. So even though I do quite a few interviews and do my own podcast on occasion and all of that, it's just like almost every day, definitely every week, there's new information, new stories, news breaking in the sector that's relevant somehow to what's going on. So plenty to talk about, as always.
And this ain't your first cycle, I gather, or pending cycle?
It's the first bull cycle that I've been invested in for uranium. I've done a pretty good amount of research on the previous cycle. There's a lot of differences between the previous cycle and this one. I'm of course aware of what happened in the previous cycle, but I wasn't invested in the space at that time.
Right. Now you're probably going to repeat yourself a bit today as you've been on numerous potties of late, but we hope to sort of rip out a bit more than than others do. So
That means you got to dumb it down for Maddie.
yeah, dumb it down for me, mate. I'm used to blowing up rocks. So, mate, I guess the latest in the nuclear world, because a lot of this mania's come off the back of downgrades for Kazatoprom's guidance. They can't get acid. We've got ramp up for Cigar, McArthur River and Cigar Lake, and no one really appears to be hitting the mark out of the big dogs at the moment when this price is as high as it is. So how about a bit of what don't people know about the lay of the land in uranium at the moment?
Well, I think you touched on a really important element of that, and especially in context historically. So right now we have a pretty constrained supply scenario in the uranium space. In the previous bull cycle, Kazatomprom, or Kazakhstan, wasn't necessarily Kazatomprom at the time, it's 100% state-owned. They were ramping production very, very quickly during that bull market. So they were going from just a few thousand tons to, by the time in like early 2000s to 2016, when they peaked production at 24,000 tons. It's just an unbelievable ramp in production that happened over the course of about 15 years and especially during the bull cycle for the commodity itself. So that's one very unique element, is that production actually was increasing during that bull market. And that's totally different in this particular situation, where we have existing producers are struggling, like you said, to hit their marks, hit their guidance. And the brownfield restarts and greenfield development projects are happening more slowly than expected. They're costing a lot more than expected. And it's just one of those sectors. It's not like oil and gas. It takes a very long time for supply to respond. So in many ways, it's like every other commodity. It goes through these big cycles where you have oversupply, leads to low prices, leads to undersupply, leads to high prices, rinse and repeat. The big difference between uranium and many other commodities is that, well, A, it's a radioactive material. So you can imagine the bureaucratic red tape to pull it out of the ground can oftentimes take a lot longer and be a lot more of a slog to get through. And B, it's more difficult to mine than a lot of other substances in terms of the geology that it's held in, the types of mines that are actually producing. We've got underground mines in Saskatchewan, ISR in Kazakhstan, and then open pit mines in Namibia and Australia, and underground mine in Australia as well with Olympic Dam.
We got ISR now too as well with Boss.
Yeah, we've got ISR's got it raised its head in Australia, which is exciting with Boss Energy.
Indeed, yeah, and that's the market's very hopeful about that project. Uranium One owned it before Boss, and they had a very hard time with it. There's complex geochemistry within that deposit. The Boss team supposedly has done a lot of work on it to figure it out, and they're getting it going. So fingers crossed. But it's not just a flip of the switch. It really isn't. And so even the primary producers are having problems right now, and that's Cameco and Orano in Saskatchewan. That's Kazatomprom and all of the joint ventures in Kazakhstan. And so the market's awaiting with bated breath for their trading update that's coming out tomorrow. So that'll be Thursday, February 1st. I'm not sure when this gets published, but they already messaged the market a few weeks back that they expected to miss, not necessarily expected to miss production for 2023, but they expect to miss their guidance for 2024 and call into question 2025. There's a lot of complexities around this, but yeah.
Yeah, so between, like, I guess, Cigar Lake, McArthur River, which is obviously Cameco and Run, and then Kazatoprom's operations, how much exposure do these guys actually have to this spot price right now, or is most of it actually contracted out? So
they have a decent amount of exposure through their contracts. And of course, it depends from company to company, how much they've contracted in the future in previous years and what those contracts looked like in terms of their structure. So Cameco, for example, has less upside exposure to the spot price currently because of the types of contracts they signed, the amount of their forward production they booked into these contracts. So that you can actually see in their financials, it'll show you, I don't have it in front of me here, but there's a graphic that shows at $100, at 110, 120, 130, 140 spot, their realized price, and the realized price only goes up about $1 for every $10 the price rise. And that's because they had these contracts that were majority fixed price that they signed in the late 2010s that they're delivering on now. Kazatomprom perhaps a little bit less or so. They also have much lower production costs than anyone else in the world. But they have a decent amount of exposure. And then, of course, the contracts that are being signed now by pretty much everyone are entirely market referenced. So they're not willing to sign fixed price contracts. The producers are not, with some exception being developing projects. If they need to de-risk financing, they'll sign some contracts and make sure that they get a fixed price that they can plan more easily around in terms of their finances. But existing producers, the contracts that are being signed right now, 100% reference to the market at the time of delivery, and with floors and ceilings. And we're already starting to hear that the ceilings are kind of potentially disappearing from some of these contracts as well.
Isn't that a bit contrary to conventional human behavior advice? You should be counter-cyclical in cyclical industries and maybe be more prudent and try and lock in a fixed price in buoyant times rather than have a market-linked mechanism in buoyant times. And the inverse applies too.
Yeah, that's always the risk, right? It's such a seller's market now that these market reference contracts, they have floors and ceilings. So the floor, of course, protects the producer. And so in some cases that works as a fixed price. It's a fixed price with only upside. So you have a market reference contract with a fixed floor. Then you also, in most cases, have a ceiling as well, and that protects the buyer. But like I mentioned, what we're hearing is the contract negotiations now, the sellers have the absolute upper hand. They are driving the car right now 100% because they went through a hellish bear market where the nuclear utilities were able to accumulate pounds very, very cheaply from Russia and from Kazakhstan. The entire rest of the mining world basically died and went through a very, very, very difficult time where the utilities, they had no incentive to go to the miners at the time. Of course, in hindsight, this would have been smart and say, okay, hey, Cameco, what do you guys need to keep McArthur River online? Let's sign a contract there. Because Cameco would have come back in 2019 and said, hey, we need $45. I'll say, all right, we'll call you in a couple of years. We're going to keep buying from the Uzbeks and the Kazakhs at $29 a pound. And so it's almost, in hindsight, what's happening now almost feels like it is and was unavoidable. Because there wasn't a scenario in which the utilities would have been allowed to overpay for uranium at any point in time to support the miners that were struggling. But in not doing so, they created this situation where you have very, very slow to respond supply and an undersupplied market. The secondary supply has all but dried up, and now the price is skyrocketing, and they have to pay the price for it. So it's a really wild scenario, and there's not a lot of buffer. There's not a lot of flex in the system. The inventories are historically somewhat low, and there's just not a lot of secondary supply coming from basically anywhere, where we had typically in previous decades in this market. In fact, throughout the history of this market up until recently, nuclear warhead downblending, enrichment underfeeding, government stockpiles from Russia being sold in the market. All of these things buffered primary supply. And all of those things are not there at the moment, with an exception of a small amount of underfeeding coming from Russia, but it's staying in Russia because they're short uranium.
I'm keen to sort of pull back the curtain on the Kazakhs and just get into them a bit more, because they're such a huge, participant in this market, but they don't get an awful lot of airtime, here in Australia. And there's this sort of narrative that a lot of the bulls in the market talk about, that their sort of supply could be co-opted by the Russians and the Chinese. Is there any sort of credibility to this risk?
Probably not, although I would say that I think the influence coming from both of those countries on Kazakhstan and on Kazatomprom specifically is much larger than the company will ever let on. So Russia already has the largest number of joint ventures with Kazatomprom currently. They have an enormous build-out program. Russia is building 18 nuclear reactors in various places in the world, and they're constructing and they're fueling these reactors as part of this export business for Rosatom. And then China, over the past just over 12 months, 2 Chinese utilities signed huge contracts with Kazatomprom. And not only do certain Chinese entities have joint ventures with actual production in Kazakhstan, the Chinese utilities are buying from Kazatomprom a lot. So these 2 big contracts were so large that the cumulative pounds under contract for that particular entity with Kazatomprom would be more than 50% of the book value of Kazatomprom. And that happened twice in the last 13 months. Why this wasn't an absolute wake-up call to the West and utilities, every other nuclear utility around the world, I don't know. But the vast majority of production coming out of Kazakhstan is going to Russia and then China. And so whether or not they can exert overt political influence and co-opt their actual production, they're buying more of that production from that country than any other nations. So they're affected. The result is effectively the same. Will we have a strong-handed move to not send any uranium to the West? I kind of don't think so. Is it impossible that happens? No. But either way, just the free market capitalism element of this, they're voluntarily buying more of that material, and they're moving more quickly to the table than the West is currently, both China and Russia.
So considering that Kazatoprom sends most of it to Russia, what effect do you think that if this Senate bill finally gets through to ban the importation of the Russian enriched uranium, is a lot of that priced in at the moment, or do you think that'll be another bit of a catalyst for another rally?
Well, just really quick. So Kazatomprom as a company, so on their attributable production, most of their sales are going to China. But as far as the actual pounds out of the country on a 100% basis, a lot more of that is going to Russia because they have the most joint ventures with Kazatomprom. So, but your second question really having to do with the Senate, the legislation, the Russian ban that's going through the Senate currently and is going to be voted upon relatively quickly here. If that passes the Senate, I think there will be at least a mild market reaction, even though technically within this legislation, they'll be offering waivers for nuclear utilities out to 2028 in order to continue to receive that material. But folks like UXC, who do analysis on the nuclear and the uranium markets, and their clientele is primarily nuclear utilities, they continue to warn that if this is passed, there's a greater than 0% chance that Russia could effectively cut off those shipments in response to this ban being enacted. So it's hard to really plant your flag and say this is going to happen. I don't have a crystal ball, but it is just one more thing that's kind of throwing a wrench in what typically would be a well-oiled global production and supply and delivery. And all of these things continue to mount up and just make the situation less and less secure. And in this case, particularly for U.S. utilities are the least covered out of any utilities in the world. There's still a handful of them that need to buy a lot of uranium going out to the end of the decade. There's still a few of them that are highly reliant on near-term deliveries of Russian uranium. So if this passes, and especially if Russia does cut off those deliveries, we're going to see a very, very large response in the physical market.
Because the big catalyst for Kazatoprom was the fact that they could not, it was the sulphuric acid supply, as I'm sure everyone well knows. What are the intricacies of that? Why can't they get the supply? Is it all being imported? Is there any on-site manufacturing of it? Like why can't they get it?
You know, that's a great question. They haven't been very forthright about that. So they continue to state that the reason that their production is probably going to miss for 2024, and it is going to miss for 2024, is because of shortages of acid. They haven't been forthright about the reasoning around that. But if you actually look at, historically speaking, the amount of acid that they use per ton of uranium produced, and I don't have these numbers right in front of me, but I believe it's 80 tons of acid per ton of uranium.
Mate, if you just say it with absolute confidence, we'll believe you. Don't worry about that.
No, I'll fact check you.
I'm pretty sure I'm right on that number, but I appreciate your vote of confidence there, guys. Thank you. So this is over the past 12 years, and there's been slight fluctuations, down to the mid 70s, up into the low 80s, but on average, it's just under 80 tons per ton of acid to ton of uranium produced, and a ton of uranium is 2,600 pounds. So what they're saying now, and this is actual messaging coming from the companies, that to meet their goals, and their goals are 30.5 to 31.5 thousand tons by in 2025. And I will tell you right now, they're not going to come anywhere near that. It's not even going to be close. But in order to achieve that, what the company is saying is they're going to need 3 million tons of acid. So if you do that math, basically what they're saying is their future production is going to require 95 tons per ton. So it's not just a shortage of uranium. It's the fact, in my opinion, and the company is not disclosing this, and they're actually refuting this. They're saying, no, we have no depletion. Of course, I think that's an absurd thing to say. You coming from the mining world, all mines deplete. Yes, there's some monstrous mines that can take decades to deplete, but depletion is it's a simple law of physics. We're talking about limited resources. So to say that deposits aren't depleting is just incorrect. So that's my personal opinion is they are moving resources into developing these two very large new deposits. And one of them is a joint venture with the French. That's the South Torqueduc deposit. And the other one is the Budanovskoye 6 and 7, which is a joint venture with the Russians. That one's a monster. That we're talking, more than 10 million pounds a year production coming from this deposit in theory. I think they were expecting 6 million out of this in 2024 and a bit more next year. So that is, of course, taking more acid to initially impregnate this ore body of this new deposit. That will take more acid. But you also have to consider that average of 80 tons per ton over the past 12 years. We had deposits depleting and new ones coming online all the time. This ISR mining, you have to drill and drill and drill and drill constantly. So we see this increase in sulfuric acid needs as twofold. One is because they're developing these large new deposits are going to need more acid, all else being equal, you need more acid, but also the acid per ton is going up. I don't see any other explanation for that other than the grades are lower and or the existing projects are slowly depleting. And you can even see on their presentations, they'll show you that, oh yeah, this hits production, then it depletes, and this hits production, then it depletes. It's no surprise.
You talk about this depletion rate. Is that like I've heard you use the word high grading, but I think is the better analogy something more like the decline rate you'll have in oil and gas and a kind of a more shale analogy as it relates.
I took the words right out of my mouth, Trav.
Mate,
Bloody, we're in tune here, mate. It seems that leaching process. Once you get into the back end of the leaching, do you need shitloads more acid to get less out?
Yeah, of course. I mean, as you're extracting it out, if you're not expanding the well fields into equally rich areas of the deposit, it's going to take more acid. Yeah. So yeah, 100%. And they've got another graphic that you can find on their website where they show the timeline for a well field, and you'll have the initial drilling of the actual well fields. You got injection wells and recovery wells, right? You get pumps that pump the sulfuric acid into the aquifer and pumps that suck it out. And so they drill out the well field, they inject the lixiviant. That takes a number of months. The ore body the uranium has to interact with the acid, and then it gets extracted. And so from the day that the well field is, or the week or month or whatever, the well fields are actually established, from that point to first production is 6 to 8 months. To peak production on that particular well field is about 12 to 18 months. And from there, it immediately declines. So they have to constantly drill and just continue to establish these well-filled grids within a deposit, because you're only going to extract the ore from the area between the injection wells and the recovery wells. It's not going to necessarily expand naturally into this entire aquifer. They have to keep drilling and drilling and drilling and drilling. And I mean, look, they've been incredibly proficient. They are and will be the largest producers in the world for a very long time. There's enormous reserve there. The geology is perfect for ISR. But they did high grade, as everybody does. They went for the best deposits first, and now it's just going to take more acid per ton of uranium produced going forward. And that's just kind of going to have to be the way that it is.
I reckon we stick on the operations while we're on fire here, mate, and head over to Cigar Lake and McArthur River. Now, Cigar Lake, as we know, look, 18%, I think, U308, phenomenal. Like, it's the highest grade hard rock in one of the highest grade hard rocks in the world. Well, it's the highest hard rock producing asset. This freezing of the ore body and the technique that they have to employ there to safely excavate it, is there any insight into how that's going?
Well, we're going to hear from the company next week, and usually they don't volunteer up very succinctly any problems that they're having. The Q&A at the end of the call oftentimes will kind of dig into the weeds a little bit better. But yeah, I mean, it's pretty much public knowledge that phase one of Cigar Lake is set to be essentially finished production by the end of the decade, 2028 to 2030. The company will tell you that they plan to move into phase two of that deposit. I don't know if that's going to require an additional shaft to be established, or if they can reach that from the existing shaft and freeze walls that are set up. But we do know that the ore is lower grades and higher cost of production in the phase two of that deposit. We believe that that Cigar phase one is already starting to see depleting grades, and I think that we're going to hear about that in the upcoming call. So yeah, I mean, it's still an enormously high grade, very large producing mine, but they are going to see decline rates as the years go on, and that's also a problem. I mean, you can actually consider the Kazatomprom ramping, that it will happen. They are building an ISR facility, a sulfuric acid production facility that will be online in 2026, according to the company. That's going to help. So 2027, perhaps we see a decent jump in their production, but that's happening as other existing mines are slowly depleting. McArthur River has a bit of a longer mine life. I think that goes out in the mid 2030s. But Cigar, yeah, for sure, Cigar, we're going to see decline rates.
And how does that freezing make it safer? Is it how does it work? What does it do besides making it colder, obviously?
I mean, my understanding is basically this mine exists in an aquifer, and they have to go through the sandstone that's above the unconformity in the basement rock. And so in order to get to that, it's basically just mining into an aquifer. So they have the walls of the mine shaft are frozen. Yeah. It's incredibly technologically complex and very, very expensive. But because the grades are so high and there's so much uranium down there, it's been enormously profitable for them over the years.
And McArthur River, what are the issues there on ramp up that you mentioned? Why are they sort of not hitting the mark?
Well, I think that it just takes time, even though it was in care and maintenance for 4 years before they decided to restart. It just takes time for them to build the staff back up to what it was, to get the gears turning again. It's just not something they can switch back on. So I think that they are planning to get that nameplate 18 million pounds this year out of McArthur. Last year, I believe, they were shooting to 14 or 15, if I recall correctly. And they'll probably get there. But, Cameco and Orano themselves are struggling to find sufficient skilled labor. And they're the name of the game up there as far as uranium goes. And they're struggling to attract that skilled labor. So I'm not sure what that means for the developers. That's going to be a major challenge. The skilled labor is a big element of this that I don't think it's talked about enough, but it's certainly a challenge for them. And
where does Nexgen fit into this? Because looking at I know for the first 5 years they're pumping out close to 30 million pounds of uranium projected, but like Cigar Lake I think's 18. McArthur River's going to be similar, and Cameco have 55 and 70% respectively of those deposits. But Nexgen's what they're forecasting looks absolutely smokes both of those deposits. How are Cameco and Orano are they going to be looking to get in there as JV, or is it too big for them to take over now? How do you think that is going to integrate possibly, or Nexgen, there's a chance they might actually do it themselves?
Well, they're certainly acting as if they plan to do it themselves. They're moving in that direction. I think that there's been skepticism, especially amongst the investing community, but also amongst just kind of the mining world, the uranium mining world, that this team would actually end up building this mine. But I got to give them credit. They have checked all of the boxes. They've got all of the nearby First Nations communities signed off and in support of the project. They've got provincial approval on the environmental impact study. They're awaiting federal approval at this point. I mean, they've done an incredible job at moving this towards getting this project built. And if you ask them, they'll tell you they're going to build this mine. Whether or not they'll be taken out, I don't know, is anybody's guess. I mean, the investing community has been pounding the table on this one for 5 years, at least, and especially during 2020, because we were just like, dude, you guys, Cameco, go in, all shares, all equity, take this thing over. And on a relative basis, Nexgen has gotten more expensive since then. But it looks to me like an attractive prospect for, the BHPs or the Rios of the world, a big multinational mining company that can actually get this thing built.
I'll have
But
to add
we'll
two things there.
see.
Oh, you go, JD. I reckon we're thinking the same.
Well, one of the things I want to ask is like that by the time it actually gets into production, it's going to be at least 15 years. So how much of that is a sort of reflection of what the prices of uranium have been, and actually how much it just, the time it takes to get a uranium project online these days?
15 years, like from the discovery.
Yeah.
Well, yeah, I mean, Cigar took even longer than that. Cigar was discovered, I think, if I recall correctly, in the 70s or the 80s.
Wow.
It was discovered a very, very long time ago and didn't start producing until, what was it, 07, 08? So yeah, it just takes a very long time. And Nexgen is they're saying that they will have first production in 2027.
Yeah, they said 4 years on the latest conference call. That was whether they were they're like, yeah, that's about right.
I think we uncovered one of the reasons why it might not have been taken over yet when we interviewed Warren Irwin, who revealed that part of his the convertible bonds that he gives to the company, he defaults with his equity position to vote with the board no matter what. So there's outsized defence that the that Nexgen have to defend suitors as a result of the convertible investment from Warren Gilman. The other thing too, Matt, they've done such a good job preparing the mine, but they even found time to sponsor F1 teams along the way. What sensible use of shareholder capital.
Yeah, they've got some unconventional marketing strategies that I think that the retail guys like to throw shade at. But hey, as long as they're getting it done, I think they're doing what no other company is doing. And you can argue that their G&A is on the high side. I think that would be a pretty easy argument to back up. But, yeah, no, I mean they're saying first or 2027. I think that I'll take the over on that one. I think even 2028 to 2030 is probably optimistic. People in this industry who are experienced with building mines, specifically uranium mines, say don't expect first yellowcake until 2030 or longer or later. The timing at which this mine is first producing is pretty freaking crucial to this sector, because it's the big mine. It's the thing besides Kazatomprom's ramp that the actual utilities are currently hanging on to. It's the only big mine really that's new that we're expecting production from. I mean, Budenovskoye, I suppose, is pretty large, but the first 5 years of material from that mine, even Kazatomprom's share of that joint venture, are already committed to Russia. So there's just no supply savior coming. There's a lot of supply that's responding right now. A lot of projects. They're just all very small. Boss's Honeymoon, Encore stuff in Texas, UEC stuff in Texas. There's a little bit in Wyoming that's happening. Cameco's talking about Rabbit Lake. Orano is going to start mining with a Sabre technology on McLean Lake that's going to be 500,000 pounds in a couple of years. I mean, the gears are turning. There's no Kazatomprom. We need another Kazatomprom, and it's nowhere to be seen. So that's the big question: is if we have such a big supply deficit currently, and the holders of inventory are not sellers, where's that flex going to come from, and what is ultimately going to keep the price from going astronomical? Because it's going to be multiple entities fighting over a limited supply. That's really what we're looking at in the next couple of years, and it's already starting right now. I don't know where the price goes in that environment.
Perfect segue for JD to rip into those inventories, I reckon, Cobber.
Yeah, I mean, the one of the key differences with this time around versus the sort of peak that everyone talks about in 2007 is the physical uranium trust. So Sprott being the most prominent there, and I'm keen just to start with how you see their impact on this bull cycle. And I mean, is there any risk that they get to a point where the uranium price is so attractive and they just sort of sell down? I mean, last time we looked, the Sprott Trust had 63 million pounds of uranium.
That sounds about right. So according to their prospectus, they cannot sell the uranium. So in order for them to do that, it would have to go to a shareholder vote. They had recently talked about implementing a redemption feature into the trust. That was something that we were really hoping would get done. Our our recent conversation with John Tapaglia, the Sprott CEO, he basically said that they're tabling that for now because they have to get a 2/3 yes vote. And not 2/3 of the votes that come in have to be yes. 2/3 of the outstanding units of the trust have to vote yes. And he knows that at least some portion of their existing unit holders do not want this material redeemed to the market. So to expect a shareholder vote in favor of selling or even redeeming for physical to actually pass, I think is a lofty expectation, is probably not going to happen. I get asked all the time whether or not I think that a government entity will come in and force them to liquidate their pounds into the market, because at some point will we actually see the grid threatened by nuclear power plants not being able to get their fuel. I don't see that happening, and I don't have a good precedent to say this is what it would look like if that did happen. But I do hope that they somehow revisit the redemption feature. I really like that idea because for two reasons. A, it solves a little bit of a physical supply problem, which the sector needs. I'm actually concerned enough at this point that we're going to see force majeure. We're going to see contracts not delivered upon, and that could even start this year. And that's not good for the industry. So it solves that a little bit, but it would theoretically glue the trust to NAV, because if you can buy trust units at 5% discount and redeem it at NAV, it'll be trading basically close to NAV all the time, which ironically would make it a hell of a lot easier for investors to pile money and to push it from a 1% discount into a premium on an intraday basis and have them raise cash and buy more uranium. So we had our fingers crossed that would happen. I think it would be a good look for the trust. I think it would satisfy the industry to some extent, and it would glue it to NAV, which shareholders would absolutely love. But for now, it's not happening. I also don't necessarily think that we'll see, I don't know whether or not we're going to see some more periods of time like the autumn of 21, March, April of 22, where money really piled into that trust and they raised $50 to $100 million a day for a couple of weeks and bought a ton of uranium. Will we see that again? I don't know. If we do, this market is so incredibly tight that we're going to see very, very large moves in the price because there's just not a lot of material out there. Those 2 periods of time where they did buy a lot of uranium, I won't get too deep into the weeds with this, but they effectively tightened up the midterm market to a huge extent, because a lot of pounds that were held that were already committed were sold to Sprott, and then those entities covered in the midterm. So because we had such a backwardated market, the spot price went way up above the midterm. There still was a little bit of liquidity in the midterm. So if you were holding pounds that you had promised to deliver to a utility 2024, and in October 2021, you could sell them to Sprott for $50 and then go and cover from the Kazakhs at 35, then you did it. So they pulled 25 million pounds out of the midterm during those 2 periods of time. And that's one of the reasons why it's so freaking tight right now.
Can you help dumb down the mechanics of the physical trust for me? Just I admittedly have never really looked into it, but my basic understanding of it is that, as people buy exposure to the physical via the trust, the flow through effect is that trust will acquire pounds on market, and the opposite is true as well. If people kind of sell exposure and they sell their units in the trust, then the flow through effect is that the trust will sell units on the spot market. Is that the basic implication of how it works?
So they will sell, if you sell, they will sell units. Is that what you said?
The flow. I mean, there's obviously
say they'll sell.
There's obviously like the is it above NAV, below NAV, etc. But like if I'm buying units in the trust, the net effect is uranium pounds will be bought on market by the trust.
Yeah, I mean, theoretically, yes, if they're trading at greater than a 1% premium to the previous day's NAV.
Yeah, gotcha.
Intraday.
So
intraday. But otherwise, generally speaking, it's just viewed as a way to have exposure to the commodity. That's pretty, because I don't think it's widely expected that my dollar put into the spot trust is going to equal $1 of uranium purchase any longer.
Sure. And why not anymore?
Well, because it's almost entirely persistent at a discount to NAV.
Yes.
So it's just the giant bucket of uranium that moves up in value as the price rises. Now, I understand it's a head scratcher from like a value investor standpoint. If they can never sell this, why is it worth anything? I get it. There's been that sort of dissent about this vehicle for years, but it just keeps going higher.
The discount to NAV, as the way I think about it, isn't that a function of the fact that you've just got a rising uranium price market? But if you had a falling uranium price market, you would unlikely see that same discount to NAV.
Just depends on the market action as the spot price is moving up and down.
Yeah, I think the crux of
if the spot price moves up and the trust stays flat, the discount gets greater.
Yeah. I think the crux of the way I think about the effect that the ETF has on the market is it accelerates reflexivity to both the upside and the downside. And yeah, I think
it does. And it has kind of a feedback loop as well with the physical market, because you'll actually see traders in the physical market recognize when risk is on in the financial markets, and they'll see, oh shoot, spot just went from a -7% to a -3% discount over the last 2 days. If they expect that they'll be buying, you'll actually see the market, the physical uranium market, front run the expectation of spot raising cash and buying uranium. So there's a lot of reflexivity. You're absolutely right.
Yeah.
I think the discount to NAV is just sort of, it's something that plagues most closed-end funds. And unless and until they can sell that uranium or redeem physical to certain entities,
yeah,
I think it's going to be mired with a persistent discount. Now, then it's of course theoretical whether or not investors will take advantage of an 11% discount to NAV, believing that risk will come back onto the sector and into the vehicle, and it'll push it back up to a -2%. And on top of the rise that it's moving along with the spot price of uranium. So it's simply a way primarily to expose yourself to the movements of the commodity without actually having to buy the physical commodity. But it has its problems, it has its flaws. It's not a perfect vehicle, but it's as far as so Uranium Participation Corporation could theoretically sell uranium, and they actually did. And not a lot. On balance, they were mainly purchasers. This was the vehicle that Sprott took over. So, but when they were trading at a steep discount, they could sell uranium and buy back shares and try to close that discount up. Now, Sprott doesn't do that, and they'll just tell you, okay, so what's my incentive if it's trading at a constant discount to NAV? Well, your incentive is your belief and our belief that that discount will shrink and go into a premium at some point in the future. That's kind of their answer.
Gotcha.
With the uranium price, because at the moment, let's compare it to what we've seen in lithium in the last 5 years, essentially, and to where we are today, how the bubble has essentially popped. We're at that same early stage of uranium, like where all the commentary, everything out there is pretty much saying there is no way it cannot go up. But are there any risks? What are the actual risks?
That sentiment in itself is a risk, mate.
Yeah, that's what I mean. That's what I mean. So what are the actual plausible risks out there where this prophecy won't come true?
Great question. I would say that, the big elephant in the room is a nuclear accident of some sort. If that happens, again, God forbid, and it's bad. No nuclear accident is good, but Fukushima, for example, it was bad, and it resulted in, evacuation of the surrounding areas and a long period of negative sentiment around nuclear itself following that accident. Nobody was hurt during that accident, yet it still resulted in a huge shift in sentiment about nuclear and a major destruction of demand. The market that we're in right now is primarily being influenced by supply. It's a supply shortage driven move. Even though demand is stable and it's rising, it's not like the demand is all of a sudden slamming the market and that's what's moving the price. Demand is relatively predictable. We can look at all the reactors that are operating right now, what their annual demand is for uranium, how likely they are to get life extended or shut down, the existing builds and when they hit the grid. And you can model all that out, and we have. So you can look at the demand, you can see it pretty clearly. This is a supply-driven move. So with all of that said, if tomorrow there was a nuclear accident and we had a certain country or multiple countries decide that in pretty short order they were going to shut their reactors down, that would have a negative demand element to it, which would probably affect the price. And it certainly would affect the stocks even faster than it affected the price of the commodity. If we had China, for example, that has 26 reactors under construction right now, if they all of a sudden said, hey, we're experiencing a very negative economic environment, we're going to halt these builds right now, and we're just going to step back and take a pause, that would spook the market. Would it actually equal lower demand? Well, if those reactors didn't continue being constructed and hit the grid in the next 5 years, sure, that lower expected demand, but it wouldn't necessarily be less demand than today. So the existing operating reactors still have to buy what they have to buy. It's a really difficult question to answer because I'm really scratching my head as to where that supply surprise could come from. Kazatomprom and Kazakhstan in the previous market, in the previous couple of decades, nobody expected them to be able to produce as much as they did, as fast as they did, to ramp from 2,000 tons in 2003 to 24,000 tons in 16. Just absolutely insane. But if they can achieve their growth, again, okay, so I'm just trying to think of what's plausible. I don't think it's plausible to have any of the development mines come online faster than is expected, to the extent that it would actually disrupt the physical market and cause the price to drop. I really don't think that's possible in any reality. I think the only flex here is China. I really think that's the biggest player, kind of on all fronts. They hold the most inventory. We don't know nobody knows exactly how much they hold. It's estimated they hold at least 500 million pounds of uranium equivalent across the fuel cycle in every form: uranium, UF6, enriched uranium, fabricated fuel. Will that uranium end up being sold into the market? Well, so far, there's no evidence to suggest that it is or that it has. In fact, the Chinese have been the most aggressive buyers. It's been exactly the opposite so far. Do we get to $200 a pound and somehow China has secured an unexpected source of uranium to the extent that they can actually sell a lot of this material in the market and profit from it? That's maybe a possibility. There's some big sources of uranium that have yet to be tapped into because of the price, because we haven't seen high prices sustained for a long enough period of time.
You mentioned before the call that you had interest investing in other commodities prior. And, we chat about mining companies all the day, and you always see these supply gaps. No matter what company, no matter what commodity, there's this massive supply gap that always comes on. And, copper is a great one that comes to mind, and you can see charts going back a decade, and there's this massive supply gap that was meant to be here 5 years ago. I'm just keen to hear if you've studied other commodities and sort of understood the reasons by why some of these haven't, eventuated to the degree that a lot of these investors had thought they might.
We've stayed entirely focused on this particular market because it is so nuanced. I think that there's plenty of historical reference in other commodities to show difficulties in supply response or accelerated supply response. But we found that this market is so incredibly unique for so many reasons. One of them is the price inelasticity for the nuclear utilities. They don't love higher prices, but they can't not have fuel. So you can actually see prices go, whereas if you saw the copper price triple, that would probably affect certain industry. We saw the uranium price triple from here. We're not going to see reactors shut down because of it. That's the only really end user demand is nuclear utilities that are operating power plants. These are multi-billion-dollar, unbelievably valuable assets that they just can't not fuel. That's their one job as a fuel buyer, is to not let the coffer run dry. Doesn't matter the price. Like I said, they don't love that the price is here. They're not going to love it at 200 either, but they're not going to not buy it and let the reactor shut down, because that is way, way, way more expensive than actually not fueling it. But yeah, no, we've stayed entirely focused on this market, primarily due to its unique nuances and, of course, the history of this market and the history of the production in this market. We had the biggest supply ramping that we've seen besides Kazakhstan in the last couple of decades has been the mining kind of revolution in the United States in the 70s and 80s. And we had more than a dozen dry mills uranium mills in the United States. There's one now that's operating. And we produced over 40 million pounds in a single year at one point during that. And I think last year we produced a couple 100,000 pounds. The industry has been decimated. But that's, again, just to kind of go back to the previous question as well, it's hard to tell where we could see supply surprises. I think China's the only flex. Like I said, there's a lot of uranium in the oceans that can be extracted. The Chinese are working on this technology right now. It's just very energy intensive and expensive to do. But if we see 200 plus uranium for a sustained period of time, will we see some extraction and some technologies come about that can make this happen? Probably. And then there's an enormous amount of uranium in phosphates. So in tails material in the United States and China, there's a lot of uranium there. It's just not cost effective to extract it yet. There's incredible amount of phosphates in Morocco. I know that the United States and the Russians and potentially the Chinese have been sniffing around there for a long time, trying to kind of establish themselves in these in the phosphate recovery in that country for the purpose of securing future uranium supplies. So if we have high enough prices sustained for a long enough period of time, most likely we're going to see supply come from unforeseen areas that we're not predicting right now. With all of that said, we have a certain, time frame for this investment. What's going to disrupt this investment on the supply side in the next, 2, 3, 4, 5 years? I just have no idea. I just don't see it.
So we had a bunch of our listeners sort of send in questions they were keen to hear you explain, and one of them is sort of moving on from there into the pricing. And people were keen to hear from you what the sort of relationship between the spot price is and how these long-term contracts are priced by the utilities and the producers of uranium.
Well, historically, the contracts have been some mix between fixed prices and market reference prices. Contract terms really are dictated by what kind of market we're in. If it's a buyer's market, you'll have more of that contract fixed and less of it referenced to the market at the time of delivery. You also had what are considered flex provisions in old contracts. When I say old, contracts signed in the 2010s and even leading up to maybe the early 2020s, the producer would offer a flex provision within these contracts where the buyer at the time of delivery could elect to take more material or receive less material than was dictated in the contract, sometimes as much as 20% up or down from the original amount that they were contracting for. And this was sort of an added bonus that was thrown into these contracts by the seller because it was a buyer's market. What has happened especially over the past 12 to 18 months or so, is that we've been in such a steep price incline for the commodity that utilities who are receiving material right now, they are all flexing up on these old contracts. So they are electing to receive sometimes up to 20% more material than that original contract was signed at. This, of course, was not exactly foreseen by the sellers at the time these contracts were signed. So it's gone a long ways to tighten the near and midterm in the physical market because every single producer is being flexed up on by their historical contracts. Like I mentioned earlier, the contracts slowly shifted to majority fixed, minority market reference, to 50-50, to minority fixed, majority market referenced, and now we're seeing 100% market reference. So if you're Cameco or Orano or Uranium One or Kazatomprom, you're signing a contract with a nuclear utility right now for delivery from 2028 to 2035, you're going market reference with floors. And that floor is going to protect you like a fixed price would. And like I said, these have floors and ceilings. Typically, the ceiling is $10, $20 above the current price. And like I mentioned earlier as well, we're now starting to hear that some of these contracts might even not have ceilings in them. So at the time of delivery, you get paid whatever the market price is with a floor. So if the bottom drops out of the market, you still have that minimum that you can count on. But you have all of this upside exposure if the keeps moving to the upside. And the fact that everybody is signing market reference contracts shows you where everyone thinks the price is going. And this is not the bullish investors talking, this is the actual market. So looking at the 3-year forward, 5-year forward pricing is well above the spot price. And these contracts being market reference tells you where everyone thinks the price is going.
So we've got a massive sort of supply of uranium, beneath our feet here in Australia. Kind of want to shift the conversation that way. And I'm interested to hear from a uranium sort of insider, but a outsider to Australia. How do you actually view supply coming online in Australia? Is that playing a big role, down the track? Obviously, we've stressed that the supply is a bit slow to react, but does that play a big role in your mind in future years?
I think it will. Yeah, I think it will. And I would love to see some of the areas that it's currently illegal have that turned around. That would be great. In particular,
So do
Queensland.
I.
Yeah, in particular Queensland. There's some big deposits that are owned by Paladin and Laramide and various other players. But yeah, I do think we'll see more uranium being produced out of Australia during this run. In the immediate term, we're talking about Honeymoon, and eventually we'll see Mulga Rock most likely be producing. And I think we're going to see more out of BHP, out of Olympic Dam, especially if we see rising copper and gold prices. Then we're going to see a few more million pounds of uranium come out of that mine as well. There's some other prospective ones, but yeah, I would like to think that we will see significantly more production out of Australia in the future. And I would love to see you guys actually build some nukes. How about get on it?
Yeah, well, we've got the all government dependent at the moment. The non-nuclear side is in, so it'll all 2025's the year whether that stays the same or gets decided. So that probably could be a big catalyst for Australia based on the political system.
I'm keen, Justin, to go into the role of China. The way you talked about China there, it's really interesting, right? So China kind of might be the biggest unknown factor on, I think, both supply and demand, to be honest with you. It's you've got it on both sides there. The biggest buyer, like you talk about, but they're also working their absolute hardest to find ways of extraction, in their own backyard to say, or where they have sort of claims on the properties themselves. We've just witnessed, a pretty crazy bull market in lithium, and there were very similar kind of lines of thinking around the supply and demand in lithium as well. Largely that it takes a long time to bring a lithium mine online. Where's the new lithium supply even going to come from? We know all the sources of production, et cetera, et cetera. It's funny reflecting on it now that lithium's really come off of that and the bubbles pop, so to speak, because a lot of the supply, and none of the Australian analysts were talking about it, but a lot of the supply was coming out of Africa. There were these African, mines which China had direct ownership of, which were basically producing. They were in a lot of ways kind of state-owned enterprises, and that was kind of seeping into the market. But people weren't necessarily talking about because the incentives of the the research analysts weren't to draw attention to it. And then you've got on the other side of it, China's not necessarily this rational buyer. They were buying crazily. Of course, from the lithium miners and also the brine producers, building inventories, and people kind of confused that buying with the actual growth rate of adoption in some ways. And then it wasn't until China stopped buying and they had sufficient inventories that a bit of reality kind of came to where. Do you worry about similar dynamics unfolding in the uranium market?
Not so much, I would say. It's true that it seems that their motivations oftentimes are difficult for the Western mind to understand. We tend to look at things with such a capitalistic view that low prices accumulate, high prices liquidate. And they simply don't operate like that. They actually have a very small amount of uranium in situ resources in China, despite the enormous size of the country. They don't have a lot of uranium in the ground, and they've struggled to get it out. They've had a strategy all along of like one third. They want to produce 1/3 domestically. They want to produce 1/3 internationally through ownership of projects in other countries, and they want to acquire 1/3 through contracting. And the reason why, so I would say that if their nuclear ambitions shifted and they then liquidated some of what they hold into the market, that would be much more of a concern than a concern that they are going to stop buying, because it's not necessarily the Chinese buying uranium that's holding this market up. So yes, they've been larger volume buyers in the past 12 months, but that's been through long-term contracts primarily. Most of the uranium is secured through long-term contracts, 85%. Spot market is just there to top up inventories and get material through an unforeseen need, like a life extension, an unexpected life extension of a power plant might see some spot market demand. But the demand that you can model out, really, going out to the end of the decade, even if China stopped building, let's just say that didn't equal them flooding the market with their inventory, but just the current reactors under construction were halted, we could still very easily model out the existing demand for the existing fleet in the world and see that we have a substantial supply deficit. So China's buying isn't exactly moving this market. It, of course, is adding to the underlying fundamentals of the market, the growth story that is China. And yes, two different Chinese utilities did sign very large contracts with Kazakhstan, but that's tying up future supply coming out of that country. It's not equaling pressure on the price currently, if that makes sense. So the spot market really it's what the investors can watch because it's so visible. It's updated intraday. The term market is where all the volume is done. And they're essentially the same market with different times, different lengths of delivery or of settlement, right? Spot market is 12-month settlement or less, but they're inextricably linked. So when we see a big move in the spot price, you absolutely believe that the term market is doing similar prices and probably higher because of the pricing in that time. So long answer short, no, that doesn't concern me, and it doesn't concern me right now. If we see, like I said, if we see sustained higher prices, we start to see the Chinese developing technologies for seawater extraction or phosphate recovery, then that's going to equal less buying from them. And less buying from them means less pressure on the producers that they're currently buying from and more material available to the rest of the world. So it's something that we're watching. It doesn't have me concerned for the near, probably even the midterm.
I'm keen to talk a bit about the actual valuations of some of these uranium companies now, as that's the sort of means that a lot of people out there would play this sector in. And just looking at various sell-side reports from different analysts over the past year or so, we were starting to see some pretty stupid things. We were seeing, double-digit earnings multiples on mining companies, which is just ludicrous. So I'm keen to hear from you what you kind of make of the actual valuations of the major players, the mining companies specifically in the uranium space.
It really depends on the company and it depends on the imputed price of uranium. I think that if you would have asked me 2 months ago, I would have argued that there's quite a few companies that are overvalued. Then we saw the price jump to $106 uranium, and you just got to crunch the numbers again and realize that they're probably slightly undervalued. I think Cameco is probably pretty rich, but it's also not just a mining company. They're vertically integrated now with their 49% ownership of Westinghouse. They convert uranium, they fabricate fuel with Westinghouse. Now they're building nuclear power plants, and so it's a totally different company and much more difficult to value. But in general, I think I have two kind of main thoughts on this. One is that I think that the sector is going to have to play catch up in a lot of ways repeatedly as the price keeps moving up. My confidence in the price moving up is very, very high. So we've seen companies like Global Atomic issue a feasibility study, 18 months ago for their project in Niger, and their feasibility study was done at 50. I think off the top of my head, $50 uranium. And it had a good IRR. It had some pretty nice looking numbers at $50 uranium. Well, now we're at 100. What do those numbers look like now? And we're going to have to continuously see these analyst reports come out on the sector and various companies in the sector with these price targets based on higher and higher and higher and higher uranium. And all of these companies, these development projects have had feasibility studies done in the past 3 to 5 years at $40 to $60 uranium. These things, in my opinion, are overdue for re-rating. And you also have to consider that the market is always a discounting mechanism. To consider the valuation of a company at $100 uranium, I think is actually kind of insane right now. By the time these things are actually producing, where's the price going to be? And that's sort of anyone's guess. So I think the sector on balance is vastly undervalued, even though individual companies are probably, some of them are probably overvalued. One of them we've already talked about that's based in your country, I think is way overvalued. But even at this price, even at $150 in uranium, it's probably overvalued. So there's a few here and there, I think, are pricing in much, much higher uranium, but I think most of them are undervalued here. With all of that said, I don't think that matters at all. I know that's an insane thing for me to say, but it's just all about flows. I mean, you can just look at these companies that have been overvalued for the last 2 years, and the ETF flows move everything. And when you have big institutional investors come in, I guarantee you, they're not doing forward cash flow analysis on Uranium Energy Corporation. They're buying it because it's liquid, period, the end. And they're buying that, and they're buying ETFs, and they're buying SPUT because it's liquid, and that's the only thing they can buy in size is the ETFs and SPUT and a couple choice stocks. They're not caring about valuations. It's all about liquidity. And so we can look at the previous market, and one of the interesting metrics in terms of valuation is not necessarily even doing a forward cash flow, because most of these companies will never produce a dollar. So if you look at it that way, everything is overvalued except for the 4 companies that are going to produce a single dollar of cash flow in the next 3 or 4 years, right? Everything is overvalued on that front. But if you look at, let's say, enterprise value compared to the in situ resource, and look at the previous bull market where we had similar price of uranium inflation adjusted in the previous bull market, where we had, you know, north of $10 a pound in the ground, and most of these companies are trading at much, much lower valuations in terms of enterprise value compared to the pounds. So relative to the previous market, these are very undervalued. Depending on your metric, you can say that they're over or undervalued. I just personally think it's all about the flows and liquidity, and it's going to keep pushing these things higher, in my personal opinion.
It's interesting your comments about going back a bit, but looking at, you know, Kazatoprom being obviously the biggest supplier in this current market. But if your prediction of like not a prediction, but a hypothesis of, imagine if BHP got a hold of Nexgen, because what's Olympic Dam? Is that about 7-8 million pounds that come out of there?
I think it's a little bit more now, but yeah, it's in that ballpark.
And if you said they ramped that up and they got a hold of Nexgen, it'd be unbelievable to think that BHP could become, if they went down that road, one of the biggest uranium producers in the world.
I don't reckon they would do it. I think they're
Be bloody interesting if they did.
It would be. It'd be a U-turn, Matty.
I don't think they love the uranium market. I don't think they love the uranium market. In fact, I've heard it's only recently that the folks at BHP that are responsible for selling the uranium that is a byproduct of Olympic Dam have kind of like perked up and like, maybe I can be doing something more with this than just dumping it in the spot market. So it's starting to sign a little bit more market reference contracts and things like that, getting a little bit more smart with the way that they're distributing those pounds. So, but I don't think it's clearly not their focus. So that's probably a long shot. You're probably right.
2 years ago, I think they didn't even really, they avoided even reporting it because they didn't want to know anyone to know that they mined it. Now they're front and center about expansions of it. So it's amazing what the price can even change their thoughts, I think.
Right. Yeah. Yeah, we'll see. I mean, in my opinion, I think Nexgen, the primary suitor would probably be Orano. And I have heard nothing on this front. This is total speculation, but because of the depletion in Saskatchewan over time, they're having problems in Niger with Somer. They're looking everywhere for uranium right now. They're in Mongolia, setting up an ISR project in Mongolia that's supposed to be first production late decade into the early 2030s. Of course, smack dab between China and Russia. Macron recently visited Uzbekistan specifically to talk uranium. And of course they have their joint ventures in Kazakhstan. I think it's a no-brainer for them, but you know, what do I know?
Yeah, a shitload more than us. But anyway, we like, as we call it over here, the word on the decline, the predictions, the rumours, the gossip. I usually make most of them up myself. I'm about a 1% success rate.
But mate, when the die hits the board.
What else you got, boys?
Justin, I've got to throw one more at you that the
Sure.
the money miners, our listeners, put to us, and they were just keen to hear your thoughts on uranium mining in Namibia. So obviously, you got a couple famous mines there coming back online, and a heap of explorers on the ASX have tenements in and around.
I don't know if you call them
So
explorers,
just wanted to get your 2
JD.
cents.
They've done about 14 feasibility studies over the years. So.
I think it speaks exactly to what Justin just said about companies that will never make money, but keen to hear your thoughts.
It's, I think Namibia is a really, really interesting jurisdiction. Obviously, a long history of uranium production. The most recent really big mine was the Husab mine that Chinese took over. That was a disaster for them. Initially, they paid through the nose for the project. Their development capex, I think, went 3x what they expected, into the multiple billions. Now it's producing pretty consistently. Of course, we have Paladin's Langer Heinrich that's getting back into production. They're just producing first ore on that restart just recently. And then Rossing is there as well. But yeah, there's a bunch of companies with these very large, low-grade open pit projects. And the big question that I have is water. I know that Namibia has been going through a drought, and word on the street is that some of these projects are still relying on this ancient desal plant that was built by the French. That's a big rust bucket. I mean, they're going to need more water to develop all of these projects. Period. The end. Where that's going to come from, I don't know. So, but yeah, all these projects are kind of like call options on uranium, right? Nobody thought these things would ever be anything meaningful, and now they're like, oh, well, the situation is such that I think we're going to need these projects online. So, what does that look like? Deep Yellow, I think, is making a final investment decision in the next few months for Tumas. I think we'll probably hear something updated feasibility and potentially some investment decisions coming from Bannerman at some point this year as well. There's a few others. Forces, I'm forgetting the name of their project. They haven't said a word to the market in 10 years, but the stock is doing well, I guess, probably from ETF flows. So, we're going to need that uranium at some point, but we still haven't seen the shovels hit the ground at $100 a pound here, even though these have been the marginal. These are the projects on the margin in terms of cost, right? They're more expensive to mine, and these are the projects where you say, okay, this is where the price needs to get to, or this is what we said 3-4 years ago when we were still looking at $30-$40 uranium. Where does it need to go? Well, then you say, okay, what do the Namibian projects need? That's that marginal cost. So we're arguably there. I mean, I think that all of these projects are probably profitable at $100 a pound, but doesn't mean that we're going to see yellowcake out of any of these projects anytime soon. We're going to have to see the investments made and the shovels hit the ground and figure out the water situation. It's probably years.
Deep Yellow is an interesting one. That's one of the most. It's always up in the top 10 of the most shorted stocks on the ASX.
Is it really? I didn't know that.
Yeah, I'm not sure if it was last week anyway.
Yep, it's up there.
Yeah.
Interesting.
Too easy. Yeah. Hey, JD, you got anything else, mate? You're the brains trust.
I'm all out. Much appreciated, Justin. Thanks for coming on the show, mate.
Oh, mate, that was...
it's my pleasure, guys.
That was bloody brilliant, mate. And God, are you sick of doing friggin' interviews yet? Or are you going to have a bit of an annual leave from them?
Yeah, I don't know. It's really interesting. I mean, historically in my life, I get bored with things when I get decently proficient at them, and there's something about this sector that just has my interest still. I don't know if it's because it's constantly changing and there's always news and it's super volatile. There's been plenty of gut-wrenching moments along the way. It's not a stress-free investment. It's not a stress-free topic to cover in a newsletter. But no, I don't get tired of it. I could talk this stuff all day long. I think it's fun. It's interesting to me.
Good stuff, mate. Buddy, check out the web address on the top, everyone. It would be rude not to give him a plug after he's given us a good, probably 2 shows of content. So we'll scratch your back, or you scratch ours, Justin. Thank you very much for coming on, mate.
Cheers,
I
mate.
appreciate it. Thanks for reaching out, guys. It's been fun.
Awesome. Right, there we go, boys. Bloody good little learning curve there, I reckon. Good to get some, mate. I think we've established between Kazatoprom and Cigar Lake McArthur River, they're really And well, didn't really consider that how much Olympic Dam puts out till I Googled it while we were talking. Like, you know, because I think Cigar Lake goes for 18 million pounds, whereas Olympic Dam's punching around 10 by the sound. So pretty big contributor to global uranium when you're talking of it in parallel with those assets. So,
Yep.
yes.
Yeah, it's chunky. It was great to hear you put the question to him, Matty. I always love these people that are, you know, really dedicated to one niche, and they get sort of quizzed on what the weak points or the potential downfalls are, or any biases and those sorts of things. So it was great to kind of hear him, you know, think through the potential downsides and really for me to learn about that Chinese aspect.
You know what he didn't point to in that when you did challenge him on the bear thesis was you know, the unwind of other supply that might be abound. You know, like could the ETFs basically, you know, unwind some supply? Could the hedge funds who are accumulating unwind supply as the momentum fades? You know, all that sort of stuff. He didn't point to that.
Yeah, I think, and look, it's pretty like everything, pretty early in this bull cycle, so things can change rapidly, as we've seen with lithium. So, yes.
Is that a contradiction? If it's early in the bull cycle, but they can change rapidly?
That is it.
I feel like it's more like we are in a bull market, and bull markets can end abruptly.
Can convert to a bear quickly. Yeah. Just, mate, as we said, once the Uber drivers are telling you they're uranium picks, that's when you tread with caution or get the fuck out. Beautiful. Love your work, boys. Mate, thanks to all the bloody partners for the show. We had KCA and SMEC Parent Technology at the top of the show. We also got our bloody great friends at K-Drill, InvestorHub, VRIFY, McMahon Mining Title Services, Anytime Exploration,
DSI Underground, Rooks Airways.
I couldn't have said them better myself, JD. Thank you very much, mate. Love your work, money miners. Hootaroo.
Hootaroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.